Welcome to the Daily Exchange. We're talking about BIS and their latest Doomsday report about Bitcoin mining with Jimmy Song today, guys. We're going to get into the detail. We'll see you guys right after this. All right, guys, welcome back. We're here with Jimmy Song, and we're talking about this new report. Welcome back, Jimmy. I just want to give you a quick introduction. Jimmy is a Bitcoin Core contributor. His Twitter handle is @JimmySong. The website is programmingblockchain.com. Jimmy, welcome back to the show. How you been?
I've been good. It's good to be back and hang out with you guys again.
Love your form. Jimmy, before we start, do you want to tell us a little about what you've been working on, your latest workshop, your book? Do you want to give us a quick update before we get into this?
Sure. So the next two seminars are in Las Vegas and London. If you are a developer and want to know about Bitcoin, I could teach you. And I've taught over 400 people. And I'm currently teaching a class at the University of Texas to a bunch of grad students, basically the same material. My book is coming out in about a month and a half, and it should be in time for South by Southwest, which is in March, where I will be speaking on at least a couple of panels. So yeah, those are the things I've been working on. I am working on an advanced course for the graduates of programming blockchain, and stay tuned for that.
Okay. And you're still working on the book. We showed the title last time. Any updates on that?
Well, they changed the cover because O'Reilly is changing around a lot of the covers. So it still does have the honey badger on it, and it's in color, but it doesn't have sort of that. I don't know what to call that. It's like kind of like between like a purple and a red, that color. Okay. That's what it used to be, but it no longer has that. But it's in color, so it's kind of nice.
Awesome. All right, let's get into this, Jimmy. We're talking about this BIS report. It's a Swiss-based cooperative of around 60 central banks. They've made a lot of big claims beyond the Doomsday Economics of proof of work in cryptocurrencies. That's what Raphael Aour, principal economist at BIS, has said. Do you want to give us some introduction? We'll get into some detail, but Jimmy, how do you feel about this whole report thing?
Well, it's kind of like a horse and buggy manufacturer saying that cars have no future or something like that. Reminds me of around 2000, Barnes and Noble going, oh, people are always going to buy books in a store, and completely dismissing Amazon. You do this at your own peril. And the thing is, like, central bankers, they have a very, very particular worldview that is all about the elasticity of money, which is another way of saying, let's distribute money to whoever we feel like deserves it or needs it or whatever. 60 central bankers, I mean, is there a bigger group of rent seekers out in the world than like a group like that? So for me, I completely discount their opinion. They have a lot of FUD in there, a lot of stuff about mining and forks and things like that, stuff that has been refuted over and over again over the past 5 years. So all the arguments are like many years old. I had an article out on Bitcoin Magazine, I think it was a couple days ago, about why mining attacks are overrated. I encourage you guys to read that. But basically, like, the assumption there is that it can get attacked and therefore it will. It can only get attacked if you have the resources to do it and the motive to do so. If you are not a sovereign government of some kind, that's going to be very, very difficult. So, most of the report is just fear, uncertainty, and doubt as far as I can tell.
Okay. So there's two, let's get into the arguments they've made, two key ones. One is that it's very expensive to keep blockchains safe from 51% attacks. And it requires a lot of it's very expensive. Proof of work mining is obviously very expensive to keep the network secure. The second one being the Bitcoin blockchain eventually stops issuing mining rewards to miners, then transaction fees will not be enough to sustain the miners to keep the network safe. So maybe let's sort of dig into that. I think you really addressed that first point in terms of 51% attacks. You need a lot of resources to go and attack that, to realistically attack that. But let's talk about the second one, I guess. Block rewards. They're saying the current technology seems unlikely to replace the current monetary and financial infrastructure. Instead, the question is rather how the technology might complement existing arrangements. So...
Yeah, I mean, their whole argument seems to be, well, we want their assumption is we are going to stay in power, and Bitcoin is going to be sort of complementary or take some other niche. They don't realize that Bitcoin is really hard money, and when you have hard money and easy money, people spend the easy money, and the easy money becomes worth less. So that's the road that they're going down. They're mostly trained in Keynesian economics, or they're monetarists or Chicago school disciples or whatever. They're not really Austrian per se. So for me, what they're hoping for is that Bitcoin will be sort of like a blip on the radar, and this report is mostly on that. Now, as far as fees, yeah, that's the big question, and this is where a fee market is kind of healthy. A lot of people complain about the fees when the blocks are full, but that's also like motivation for the miners. In something like 10 short years, we're going to get to a block reward that is 1.625 Bitcoin per block. And depending on the price of Bitcoin, that might be plenty, but it decreases very, very quickly. Every 4 years it halves. I mean, if Bitcoin doubles every 4 years, then we don't really have that much of a problem. You can get the same amount of at least resources dedicated to it. But the nice thing is, once you have fuller blocks and so on, you're going to have more fees, and that can definitely help the miner out. There was a block in I think late 2017 where you had 12.5 block reward, but also over 12.5 in fees, and that it was only like a couple of blocks, but I mean it's definitely possible for fees to outpace the actual block reward, and that's what it's going to have to go to over time. Now, does that make it more vulnerable? I mean, arguably, but you still need a lot of resources. And the thing about mining attacks is that if you have a 51% attack, you can really only do just like 1 or 2 double spends, and maybe you could do several or something like that. But really, who does that hurt? Well, that hurts the exchanges that accepted them and let them get away with it. But pretty much everyone else is not really affected. It's somebody stole from somebody. Yeah, that happens all the time in Bitcoin, right? Like if you have your private key stolen, you'll lose your money. So to me, it's not that big of a deal. A lot of people have sort of this mentality that it'll ruin Bitcoin forever if there's 151% attack. You saw what happened to Ethereum Classic a couple of weeks ago. That didn't drop much at all. It was just... Yeah,
I think we reported that it actually went up above. Well, it went down less than Ethereum went down, which is fascinating.
Yeah, I mean, as far as if you're a holder, you don't really care that an exchange lost money. It's not very different than, say, a hacker going into the exchange and stealing a private key or something like that. I mean, like, yeah, they got screwed over, but okay, so I mean, that happens all the time anyway.
A big question, we've got Davos has just sort of come online. This report's come out as well. There seems to be some sort of timing potentially between these two things. But then on the flip side, you've got the NASDAQ president, Adina Friedman's come out and put AI and cryptocurrency on the top of their list. Also released a LinkedIn post. Joel, I think we've got an image here of it where it's titled, "Cryptocurrencies could still be a global currency of the future. Perhaps," obviously, I guess this is in complete contrast to BIS. NASDAQ is, a very recognized institution in terms of what they're doing. Do you think this is all just FUD?
Oh, I mean, the BIS report, I think, is. As far as the NASDAQ president, I don't know how much he actually knows about Bitcoin and crypto and everything else. So I like a lot of these guys that are at the top of these institutions. They've played a lot of political games to get there. So you have to take almost any statement that they say with a grain of salt. They might be saying that as a way to, I don't know, pump something. There's usually an alternate agenda that the public isn't aware of. So I mean, he might like those are two real buzzwords to me. It's like cryptocurrency and AI. Okay, well, I do know what AI actually is. It's mostly like adaptive algorithms and things like that. It's not like it's an actual intelligence, right? Like it's a lot of this stuff is hyped up to mean something more than people think it is. I suspect that this guy has a similar view, and he's kind of playing buzzword bingo a little bit.
Buzzword bingo, I like that. So a lot of people, they're talking a lot about, in the report, about the cost of securing the network. You know, and then I guess attackers have a lot to gain in terms of, you know, just the sheer size. And then, but on the flip side, you know, I guess it's the network's potentially worth, and has been up to, is worth about 63 billion, sorry, and has is worth, at its peak, was up 300 billion, right? So that's it's a pretty sizable network. Do you think the cost actually of securing Bitcoin is actually relatively cheap to what is at stake and what is of value?
Yeah, I think so. I mean, you look at something like gold mining. To mine an ounce of gold costs very close to 1 ounce of gold. It's not a coincidence. And the cost to you know, mine 1 Bitcoin is not surprisingly very close to 1 Bitcoin. And that's what happens over time. That's a feature, not a bug, because that means that much energy, effort, time, whatever, after you factor all of that in, that's how much went into creating that. And it's that's what you call hard money. It's difficult to create. And that's a feature, not a bug. If it's difficult to create, then no one can just sort of issue it. And this is the key feature that people, I don't think, really get about money, is that if it's easy to create, then it will be created. Nobody is that virtuous where they're not going to create money when they have the ability to. Almost everyone wants to create money. But if you make it very difficult and the rules are objective, then only the people that specialize in that will go into it. You as a person would rather go and do something that you enjoy doing or are good at, have a lot of leverage in, rather than going into the money printing business. And this is one of the rants that I always go on, is think about like the last 40 or 50 years. Where have the the brightest and most talented people been going, right? Like investment banking. It's kind of crazy that they're all going to investment banking. It's not because they're particularly good at investment banking. It's just that that's where they can make a ton of money and like not contribute as much. And that's, I think, very tragic, because instead of building out civilization and creating new machines and figuring out like how to get a colony on Mars or something, they're working on like financial games, zero-sum games for the most part, to gain a lot of money for themselves. So I mean, this is all part and parcel of what happens in a fiat system when you do have easy money. The hard money in Bitcoin is a feature, and that's a very good one.
Okay. Let's dig into this. So one of the parts of the report, Jimmy, is about proof of work mining and block rewards. And I just want to read a couple of quotes here and get your view on this. They've said, second, the transaction market cannot generate an adequate level of mining income via fees, as users free ride on the fees of other transactions in a block and in the subsequent blockchain. Instead, newly minted Bitcoins known as block rewards have made up the bulk of mining income to date. Now, I'll just quickly, I'll just recap there. You suggested, and which is correct, is 12.5 Bitcoin a mine, sort of, on average around each 10 minutes, and this is expected to halve and halve again in 2021 or 2020, depending on difficulty, but it's expected around that time. They're saying, looking ahead, these two limitations imply that liquidity is set to fall dramatically as these block rewards are phased out. Now, I think that's an interesting statement. in and of itself. They're really talking about liquidity now, not about block rewards or fees or protection of mining. So I want to come back to that in a sec, unless you wanted to have a comment about that now.
Well,
Jimmy.
it's interesting that they think that liquidity is going to fall just because there aren't as much block reward sort of coming online. I mean, if you know anything about mining manufacturing, a lot of them actually kind of hold, right? Like they put a lot of capital investment up front. They pay their bills, but they're VC funded. They can hold this Bitcoin until it's advantageous to sell them. There's an inbuilt assumption in this report that says miners sell right away, and that's not necessarily true. It's about as true as gold mining manufacturers selling their gold right away. That doesn't necessarily happen. I'm sure some do, but it's kind of like the Homo economicus or whatever it is, like the perfectly rational human being, or like spherical cows and whatever assumptions that you need to make in order to make your report sound good. It just doesn't make any sense.
Yes. So there'll be less Bitcoins available than block rewards. Yes, but I guess that's the whole value proposition in and of itself of Bitcoin. They've also suggested, simple calculations suggest that once block rewards are zero, it could take months before a Bitcoin payment is final, unless new technologies are deployed to speed up payment finality. So this is interesting, and we'll start with this is, Jimmy, when block rewards do eventually stop, how do you think the network will support itself?
With fees, and it'll be mostly probably opening and closing Lightning channels or going in and out of side chains or something like that. But those can encompass many transactions. So on a per transaction basis, it'll still be fairly cheap. But accumulated together, it might be fairly significant. And it's a supply demand thing, right? And there's a limited amount of block space, and as long as that remains true and the network, has enough transactions to process, I don't think it'll be a problem. There's a lot of faulty assumptions in that report, and they're just sort of like building on a faulty assumption. So pretty much any conclusion that they come to is completely invalid.
Okay. And so I guess, are you aware? So, can you talk us through any proposals that so you're aware of to help keep miners engaged in the network? If I guess mining is not profitable, or how do you see that playing out?
Well, the nice thing about Bitcoin is that the difficulty adjusts according to how much hash rate there is. So if it's no longer profitable, miners naturally go off and stop mining, and that's kind of what happened in December. A lot of, I think, electricity contracts ran out at that point, and a lot of miners just stopped mining, and we had difficulty drop 10, 20, 30%. But then, more people got in because they had more efficient equipment and so on, and then they, continued to mine, and difficulties got up again. So, that's the natural, economic incentives at play. And I think what this report is saying, well, once it's low enough, then you can attack it easier. I don't think that's necessarily true. Okay. The technology keeps getting better, and there's a lot of competition, and there's a lot of money involved. If you are really good at designing ASIC chips, then you can definitely overtake a lot of other ones, and you can get an edge and things like that. It's no different than say gold mining. How are gold miners going to bring new gold into the system if gold drops in price? Well, a lot of them won't, but there's always sort of technological advances and so on, which make that profitable for somebody, and it's kind of like a linear extrapolation of the current situation. And that's always dangerous when there's innovation involved, because there's always something new that comes along, some entrepreneur that figures out how to do things better.
So true. And let's talk about, so there's a here now, we'll just move to the quote they've suggested on Lightning Network, and I'll just read it for you. Is second layer solutions such as Lightning Network might help, but the only fundamental remedy would be to depart from proof of work, which would probably require some form of social coordination or institutionalization. Now, this seems very, very strong in my books, Jimmy. But I would like, how do you? What's your initial? I guess I'd be interested in your initial reactions to at least that statement to start with.
Yeah, I mean, they don't. I mean, like, there are central bankers thinking that everything should be central banky, and everything should use fractional reserve, and that elastic money supply is a virtue, and not just counterfeiting, which is what it really is. It's ridiculous. What they are suggesting is that we move to proof of stake. Proof of stake is nothing more than signatures, and you know what has a lot of signatures? The dollar bill, right? Or the currency of your country. That it has a bunch of signatures. That's what proof of stake is. It's instead of securing it with like steel, you're securing your coins with like paper, right? Like it's not that secure. It's because it's just a bunch of signatures. And there's a Medium article that was released recently about a particular form of attack, because validation on proof of stake is significantly harder than proof of work. Proof of work, you just take the block header, hash it, and see if it is a low enough number. With proof of stake, it gets a lot trickier because there's, like who was supposed to sign it, among which stakers, and there's all sorts of attacks around how to do that, and the validation costs can get really significant. And yeah, it's just not secure. So it doesn't I think central bankers are thinking that everything should run like a central bank, when in fact, like, this is exactly the opposite of how central banks run. So they're like, why can't they be more like us? And we're like, because we don't like the way you run. That's the whole point of this project. So yeah, that's my take on their opinion on proof of stake.
Okay, and just want to clarify for everyone who's watching, just to get really clear, how do you see the Lightning Network solving this issue? With mining block rewards going down, obviously more transactions coming on, potentially transaction fees, going up. How do you see Lightning Network solving some of these issues?
Yeah, so the atomic unit of the Lightning Network is what's called a payment channel transaction. And a payment channel transaction is if I owe you $5 and then you owe me $3, then we can just net it out and just have one transaction that's $2 from you to you. And you don't have to do that for just like two. You could do that for like 1 million transactions. And if you have a network of payment channels, then you can do that for a lot more. So really, every transaction on the Bitcoin ledger can represent lots more transactions. So you might be paying a lot in fees for that one payment channel transaction, but what that represents could be potentially thousands or millions of transactions. And that means that on a per transaction basis, you can pay a lot more. And that's as the capacity of Lightning continues to grow and more people use it, that's how it would work. But I mean, that's not the only layer 2 solution, right? Mm-hmm. There's stuff like side chains and other things, and it's really up to the market, really up to the users to figure out what they prefer. And as the economic incentives go in a particular direction, they might be more comfortable. Okay, well, let me just open a giant Lightning channel, and I'll only bring out like my cold storage when I really need to. I mean, people do that with like real estate, right? Like they have a lot of the value in the home, but to flip it can be pretty expensive. But for their day-to-day transactions, they have like a bank account. It's okay to have things in multiple sort of forms, and Lightning is just one of the many potential ways in which you can transfer value.
Okay, so just to condense that down, what I'm hearing as well, Jimmy, is that there'd be one transaction eventually that nets back with a Lightning payment channel, and so the transaction fees can sort of all stack up inside that payment channel, and then once they're all stacked together, that pays for the Bitcoin blockchain transaction, which eventually goes back. But they've been obviously netted off, and they've, maybe even millions of transactions could have taken place within that payment channel, and therefore they can pay for the higher transaction fees.
Yeah, I mean, at least that's one possible way in which this can play out.
Yep.
Again, this is you're trying to predict innovation, and people are notoriously bad at that. You look at predictions of the future from 100 years ago. People were like using bodysuits to fly or something like that, right? Like it's hard to, most people can only linearly project, which is what these central bankers are doing. But the future is often very non-linear and hard to predict.
Jimmy, what sidechain solution are you most bullish on? What's the one that you said there are some alternative ones as well. What's your view on? I know that's again very hard to predict, but what's your sort of expert opinion in terms of where you think sidechains will go?
Well, so there's two right now that exist. There's Elements, which is what Blockstream does, and that's more a federated model. So you have to trust the supermajority of the people that control that sidechain. And I think it's right now mostly exchanges. So I think they have like 15 exchanges on there. You have to trust that like 11 of them are going to be honest in order for that sidechain to work out. That's one model. The other one is something called drive chains, where you can get into the sidechain. Getting back out tends to be the tough part, but there's this clever mechanism to have miners sort of slowly bring it back. So it takes like months to bring it out of the sidechain, but it can be done. But it's incentivized in such a way as to make the miner want to tell the truth and not try to steal. So, I mean, there's a whole ecosystem around both of those, and they're interesting, but those are the only two that I'm really aware of. Which one am I bullish on? I don't know. I know Liquid allows for a whole bunch of stuff like confidential assets and confidential transactions and all this other stuff. But yeah, I mean, I don't know. It's, again, up to the market, and it's up to entrepreneurs to come up with use cases for these things and convince other people that these will solve problems that you might have.
Okay. Just, I guess a little bit alternative here, because I think we're, talking about alternative protocols and things like that. The creator of BitTorrent, Bram Cohen, has said, once said that blockchains fundamentally require waste, while pitching some alternatives to proof of work, that is. His solutions require users to give up some sort of resource in order to secure the chain. He's calling it proof of space, where you basically give up disk space. Do you think that you need some sort of consumption to give a blockchain its value, or ensure that it's secure and ensure that it's safe?
Yeah, so I know Bram, and I know about his proof of space and time thing. I think the best description I've heard of it is he's trying to cheat the laws of the universe, right? Like, because when you're trying to secure something, you need to put in enough work that it's actually secure. So it'd be like, well, the steel around that safe is a waste. It's not really. That's what's required, so no one can come in and get your stuff out of the safe. And that's how I view proof of work. It has a function. It secures the network. It secures all your transactions. And in order to pry open that steel safe, you need to put in an equivalent amount of work. And that's what gives it security. A lot of people like to call it waste, but the much bigger waste is when you are able to print your own money, which is what central bankers do. And you have the entire banking sector, which is like 10-12% of GDP, at least in the US, that are essentially rent seekers. They don't add anything to anybody. They don't create anything. They don't economically make anything, but they get to tax transactions in one way or another through inflation, lending, whatever activities that they end up doing. So, for me, it's idiotic.
Okay, I know we've got to come to we've got a bit of a hard stop, Jimmy. I just thought if there's one last question we could just talk about with MimbleWimble. We talked about that with Grin and Beam launching. It was, I guess, proposed as potentially an upgrade for Bitcoin at one stage, which is interesting in and of itself, with its privacy features, potentially, it could be integrated back into Bitcoin, which is of interest. It has very similar properties in terms of how it was put together and things like that. I guess I was interested, just to finish off. Do you think that something like MimbleWimble could be added back into Bitcoin? In other words, I think a lot of people have this theory that Bitcoin sees a lot of features, a lot of proof of concepts out there, and merges them back into its central core, and over time, do you think Bitcoin's going to take over all other cryptocurrencies and protocols like that?
Well, so the only way MimbleWimble, I think, could work in Bitcoin is as a sidechain, and you would need to put your Bitcoins into a MimbleWimble sidechain, and then you could do all the confidential stuff. I'm actually not as keen on confidential transactions as I used to be. It is nice that you get that privacy, but the biggest thing that you need out of money is provable scarcity. And when you have confidential transactions, you're kind of having to trust the math. You have to trust that the amount, like no one has broken ECDSA, for example. And that means that if they did break ECDSA, if I broke ECDSA, the first place I would probably go is Monero, or, well, actually, I think that uses something else. I would go to like Zcash or something and try to figure out a way to create a giant transaction for myself that has a lot of money, and then inflate that currency and sell, just continuously sell on the market without anyone really knowing, because it's all confidential. So to me, like there's a downside to that privacy that a lot of people are kind of overlooking, which is that, you have to trust more stuff. And yeah, it's a mathematical, the difficulty of a particular math problem, but it's trust nonetheless. The less things you have to trust, the better it is for money. And for Bitcoin, you don't have to trust very much. The entire UTXO set sums up to exactly the amount of Bitcoins in existence today, and you can verify that like running a full node. So that's the more important feature. MimbleWimble, Zcash, Monero, all of these guys have, they hide the amounts and so on. Which has its uses for certain things, but to me, that's not the killer feature. The killer feature is scarcity.
Okay, Jimmy, I know you've got a hard stop. I thank you again for joining us on the show, and appreciate you coming along. And again, those workshops coming up can be found on programming, the website programmingblockchain, I believe, .com.
Yeah.
And do check them out, guys. Do go along. Jimmy is the master when it comes to these kind of things. Thank you again for joining us, Jimmy. And we'll see you obviously next time on the show.
All right, sounds good. Thank you.
All right, guys, we're going to wrap up with a few final bits and pieces here in trading trends and news. To give you guys an update, that is a couple of sirens. That's New York. That's real New York siren. Can you hear that? That's real siren. I love that. Couple of movements overnight. We had Redcoin up quite a bit, leading the charge around 24%. Waves and Nano looking up about 10%. The market grew about 1.5 billion overnight. 10x and Loopring are down about 10%. They did a big movement yesterday, as you know. We talked about that yesterday. The thing is, but the prices themselves haven't really moved all that much overnight. The volatility is definitely a lot lower than it was in the past. We're in this, I guess, this phase right now of less low volatility. And I think there's uncertainty really in the market. Prices right now, Bitcoin trading at $3,590, Ethereum at $119. We've got Waves again up 14%. Tron at 2.7 cents, Ethereum Classic at $4.40, Ripple at 31 cents, and EOS at $2.46. Lastly, we've seen a bit of news right now with Bithumb wanting to go public in the US. According to CNBC, the parent company Blockchain Exchange Alliance has signed a letter of intent to enact a reverse merger with existing US company Blockchain Industries. Interesting stuff. A reverse merger is an unconventional method of obviously getting publicly listed, but it's probably the way in which a cryptocurrency company will come onto the public market. Then lastly, we've got Saudi Arabia and the UAE plan to collaborate on a cryptocurrency. I'm not sure if you've got a screenshot here for us, Joe. It's a basically, according to the national leading publication in the Middle East, Saudi Arabia and the UAE have made an unprecedented and historic agreement that will see them collaborate on developing a joint cryptocurrency, a customs union, and a crisis management plan. You can see the news here, which is really cool. That's a really cool room. I wish I had like that kind of vibe in here. Joel, imagine that was our background. That'd be really cool. The cross-border digital currency will be strictly targeted for banks at an experimental phase with the aim of better understanding the implications of blockchain technology and facilitating cross-border payments, state news agency WAM reported on Saturday evening. Let's see how all that cryptocurrency goes. Guys, do subscribe, click the little bell above, and we'll see you guys tomorrow. All right? Yeah!